Welcome to the Passive Mobile Home Park Investing Podcast with your host, Andrew Keel. This is the podcast where you can get the education you need to invest 100% passively in the highly profitable niche of mobile home parks.
Welcome back to the Passive Mobile Home Park Investing Podcast. This is your host, Andrew Keel, and today we are going to discuss reason number 10 why you should invest in mobile home parks. The 10th reason is because there are attractive financing options currently available for the acquisition and refinancing of manufactured housing communities. Fannie Mae, Freddie Mac, CMBS, and others currently lend in the space. This leverage assists in the boosting of returns for passive investors. As of this recording in 2020, typical financing on mobile home parks that one can expect is around a 70 to 80% loan to value, meaning the purchaser is required to bring a down payment of only around 20 to 30%. The typical amortization period is around 20 to 30 years. It's important to note there are interest-only options available as well from some of the larger nationwide lenders, but the property must qualify and be a certain level for those. Operators can typically fix an interest rate for a time period around 5 to 10 years, and the typical interest rate as of this recording is currently around 3 to 5%, which is historically low. Prepayment penalties will usually apply with all financing options, whether an operator chooses to go with a local bank or a large nationwide lender. Different sized communities will allow for different financing options. Usually, the bigger the community, the better the debt it will be able to, ultimately secure. Also, having a higher property class grade will ultimately open better financing doors. For example, an A-grade 55 and older, fully occupied mobile home community in, say, Sarasota, Florida, with around 200 lots and amenities such as a swimming pool, a par 3 golf course, and a community room, will usually be able to qualify for the best financing available, which currently would be with the agencies, Freddie Mac and Fannie Mae. This debt would be non-recourse, which is huge, meaning that the only collateral for the loan would be the real estate itself. This type of community could expect to get around an 80% loan to value, usually 3 years or more of interest-only payments, and a 30-year amortization after that. This type of property will usually be able to get around a 10 to 15-year fixed interest rate as well. And the interest rates on this type of community would be the best available, which currently are around 2 to 3%. Talk about some good financing terms, huh? On the opposite end of the spectrum, a D-grade, all-age mobile home community that is 50% occupied in, say, Indiana, with 50 lots or more, they would likely have to get bank financing, a local bank, to finance the purchase of the property, and this would require recourse debt, which is debt that is backed by collateral from the borrower and not just by the real estate itself. Terms that could be expected would be around a 60 to 70% loan to value, a 15 to 20-year amortization, a fixed rate of around 5 years, and an interest rate of around 4 to 5%, which is still really good. On some fixer-upper value-add deals like this, the local banks can require operators to hold their operating accounts with the capital expenditure funds in it at the bank after closing. The bank can then require invoices or photos to show proof of improvements in order to release the capital expenditure funds to the operators. The debt service coverage ratio, or DSCR, which is the net operating income divided by the total debt service that most banks look for, is around a 1.25 and above. This ultimately means that the income a property generates will need to be able to cover the debt payments even if it is reduced by 25%. In conclusion, there are a variety of different financing options available to operators of mobile home parks. Partnering with an operator that has a good network of financing connections is uber important for the long-term success of an investment. Overall, having this many financing options available is a positive note to investing in mobile home parks. That's it for today. We'll see you next week when we discuss the reasons why mobile home parks are recession and inflation resistant. Thank you so much for tuning in. Would you like the pre-investment checklist that I personally use to review mobile home park deals before I invest in them? We are offering this as a free gift to those of you who go to iTunes and leave our podcast a 5-star review. To get the pre-investment checklist, leave us a 5-star review on iTunes and then send us an email to passivemhpinvesting@gmail.com. In the email, please tell us who you are and what screen name you used to leave that review, and we will send out the pre-investment checklist directly to your inbox. It's that easy. Once again, that email address is passivemhpinvesting@gmail.com. Thanks again for tuning in.